All down. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host, Kieran O'Brien, and with me as always is Mr. Peter O'Malley. Peter.
Kieran, good evening to you.
Good evening, friend. There are very few podcasts that we record that I am super excited about. I always love doing the show, but there are some that I get, pretty worked up about. And one of them most certainly is the post-budget podcast, where we get to talk about not only the budget, we get to rib a little bit on the government of the day, but we also get to talk about what in the budget is going to have an impact for our listeners. Now, I won't pretend this evening that we are going to break down the budget in its entirety. There's websites and newspapers and other podcasts for that. What I want to talk about tonight is there's been a lot of discussion around proposed changes to the property sector in this budget, many of them aimed or under the guise of facilitating home ownership for those less able to purchase in our society. Given that we've been talking a little bit about some of these changes for a while, now the budget is out, I thought tonight let's break down what are the recommended or proposed changes to the property sector in particular. And then once we've talked through those, we can get a little bit more detail, a little bit more granular around what the impacts of some of these suggestions or changes are going to be for, the various people that operate within the market.
Yeah, thanks, Kieran. The budget was as significant as it was tipped to be leading into it. There's no doubt about that. And there's no doubt that politically speaking, it's a broken promise by the government.
Yeah.
I think in time the government are going to have to acknowledge that themselves. The issue that I have is that it's a broken promise predicated on a lie at worst or false information at best. And what I mean by that is when we do talk, which is the part of all of this that I'm passionate about, is the impacts that these changes will have in the marketplace. This is not going to help first home buyers.
No, and you always say this about government policy, right? There is so many decisions made at the executive level that look good on a spreadsheet, they look good in a think tank, the focus group that's 3 or 6 or 8 or sporadically chosen people suggest might be an idea, never inevitably flow down in the direction that the government of the day thinks it will, ever.
And particularly this one, and we'll unpack it here tonight as to who the winners and losers are from the negative gearing and the capital gains tax. But lots of commentary today, and everyone has a different view. But I like this one from Noel Whittaker, and I've always liked Noel Whittaker because when I was a furniture removalist, when I first left school, the first sort of self-help book I ever read was a Noel Whittaker book, the red one with all of the dollar coins on it. Most people who've read that will always remember what a great book it was, written by Noel. But he said this morning, intergenerational inequality is a social construct invented by Labor to give them another class of victim to help. And this policy that we've seen in the budget is Labor purporting to help first home buyers, where really what they're looking to do is have the government benefit of negative gearing that they give to private households for established housing. They want that redirected towards new stock, towards developers to build properties for people that they're going to keep inviting into the country. So what became clear out of the budget for me is that the immigration levels are not going to be peeled back. The government is hell-bent on building more properties to house more people in this country.
One of the well said. I think it's. I often get the sense from Labor, and as we've talked about before, I'm someone who has always kind of been more traditionally aligned with the centre and the centre left. But I've often always thought that Labor loved this concept in their policies of creating someone to assist, right? And it's not to say that there isn't social justice issues. There certainly are. There are people that require government support. There always is under every government. But as we've talked about previously, and as this budget shows, they are always finding a way to create someone else who's marginalised, or create a situation where people become dependent on the government for some kind of facility, resource, whatever it might be, and then put policy that looks like it's assisting that group, but inevitably never is. And, we see it all the time with the first-time owners grants, with the 5% deposit schemes. I mean, it looks, on paper, they can say, look at this amazing thing we're doing.
But the benefit ends up downstream.
Well, upstream in this case, right? Because it doesn't flow down to the 90% at the bottom. It flows to the ones that own the property already.
And then if we go to say the Sydney Morning Herald homepage today, and you were telling me earlier about the Telegraph homepage is first home today, but the Herald today is saying that Chalmers burst boomers' bubble.
Yeah.
Well, that's just not correct. Boomers have made their money. They're in the back end of their life.
Yeah.
Negative gearing has worked for them. This is so obvious.
Yeah.
First home buyers or young adults or aspirationals that are working and trying to offset tax and make it all work, they're the people that now will not get the benefit of negative gearing in the established housing market that baby boomers got.
Well, similar vein, and it's sorry to segue slightly, but it's unrelated to property directly, but the superannuation taxation changes. The pension class or the pension phase of superannuation will remain untaxed, which again benefits those boomers that are in that phase of their funds usage, which again, I'm someone who thinks we probably shouldn't have touched super, but the people that are in the accumulation phase, younger people, then get two taxable events that's going to further diminish their ability to save for retirement. I mean, it sounds like they're trying to target the boomers on paper, but in reality, they're the ones getting all of the breaks here, and they've already made their money, as you say.
Yeah. So I'll tell you something that was ironic about the budget last night. Bill Shorten lost the 2019 election on these very policies, yeah?
Which we talked about not that long ago, in fact.
Yeah. Bill Shorten's birthday is May 12th. It was Bill Shorten's birthday on budget night.
I did not know that.
Yeah.
There you go.
So I have no idea what Bill was thinking with a cold one watching that.
Maybe celebrating the death of the Albanese government.
Watching the policies that cost him the prime ministership, being introduced to the parliament as fact. It was just talk about an ironic moment, right?
Yeah, I didn't realise it. I love that you opened the episode, before we get into the brass tacks, I guess, I love that you opened the episode by talking about, this being a budget that's a broken promise, because it's not, not to dredge up the past, but it's not the first time we've heard a government go to an election, make a promise, there'll be no GST under government I lead, etc., and then turn around and do precisely the opposite. I think, though, in this case, it stings so much more because Labor has always touted themselves as the party of the working class, of the lower end, of the underrepresented, the undervalued, the underappreciated in society. And in fact, as we will discuss and we have discussed, they're making it so much harder for that pocket to get anywhere and to ever pull themselves out of the ditch they're in.
Yeah, look, I don't want to get too political because I'm only interested in the budget as it relates to property, that's for sure. But I will say, in saying all of that, I will say that right from the very beginning, I was just like, this is not going to be a good night. Labor have not managed the economy particularly well in their first 4 years of government.
Yeah.
NDIS was out of control under the coalition in 2021, but under Labor's stewardship, under their governance, the NDIS has just become outrageous.
Yeah.
There's other rorts in social welfare that's happening out there. So Labor have had 4 years to get the economy right. They were bringing inflation down, and then through too much government spending have sent inflation rising again to be one of the highest inflationary economies in the world. And Jim Chalmers spent the opening 5 minutes of his address blaming the war that started 2 months ago for Australia's economic woes. I just found that hard to stomach, where it's like you're trying to wipe what's happened in the previous 4 years and blame everything that's bad on what's happened in the war in the last 2 months. And that's just hard to stomach. And I think at parts of his address on budget night, he took us all for fools.
To be fair, we only talked about this last week before. No, I think it was last week actually. That the RBA statement had set up the government for this position, though,
They did.
to position and say, well, obviously the war in Iran is the only thing that's impacting inflation, and we expect that it will settle. I saw, one article I read today.
Managing inflation and taxing the daylights out of, successful management of the economy prior to are completely different events, right?
Look, of course they are, but
They've ripped up
I'm
the
not
rule book.
surprised that was the statement made by Chalmers, though, given that we'd only said a week ago that was the likely position, and the RBA was set up to assist in that space. I read one article just before we do get down to it today, and one of the key takeaways they were suggesting was that out of all of this, with the proposals in the budget, the kind of blind optimism that the war will just end tomorrow and the barrel price of oil will drop so rapidly overnight that everything will go back to normal quite soon. This is the kind of optimism of the government. When in reality, there are forces working together at the moment that combined with some of the spending in the budget, combined with the war, etc., there's so many factors. We could be facing a 7% inflationary figure before too long if things don't slow down rapidly and quickly.
Oh, that's highly conceivable.
Which I can't even imagine the damage that does to households down the line.
Well, that's what we said about the RBA statement last week, is their baseline case was for the war coming to a quick conclusion.
That was cross fingers. That's what that was. Closed eyes and cross fingers.
It's like, I'm not sure what they're watching, but I'm not seeing any quick conclusion to that conflict, that's for sure.
Oh, look, who knows? It may end, who knows? That's not what we're here to talk about. Let's get into, so we're focusing tonight on the key changes in the budget that affect the property market. Let's begin, if you can, taking our listeners through the major proposals put forward, and then we can break down a little bit about what the likely consequences are.
So negative gearing on existing properties is essentially banned now, or it's not permissible.
Yep.
And to get negative gearing on a dwelling going forward, it'll have to be a brand new dwelling.
Yep.
Now, the concept there is we don't want to create a housing bubble in the established market on the one hand, and on the other hand, we want to stimulate building from developers at a time that they're struggling to make projects feasible. So what the government is essentially trying to do is send the investment community, if you like, or the investment pool of buyers, redirect them from established dwellings and send them straight at developers. So the larger the developer, the more they'll benefit from this. So some developers have come out and touched on elements of the budget that they don't like, but by and large, of all of the commentary today, you'll notice that property developers were fairly quiet, because it's like we were competing with established stock for the investor market for so long, and now it's 100% exclusively ours.
Yeah. Oh, absolutely.
Yeah. Now, what that's going to do is create a price bubble or a premium in brand new stock.
Yep.
As investors over time value those properties higher than what they do existing stock because of the tax breaks they get.
Yeah.
And you're going to get what you can probably call the new property syndrome instead of the new car syndrome. The new car syndrome, as you know, and I looked at it on the internet before discussing things with you tonight, as soon as you drive it off the parking lot and its status goes from a brand new car to an existing used car, it drops about 10% in value. Most people accept that, yeah?
Yep.
I don't know what, in percentage terms, what premium will be in place for these new properties. It might be 5%, 10 or 15, who knows? But there will be a premium the market finds itself building into brand new properties, and that will be the investor premium for the negative gearing on new properties. And as soon as the buyer settles on that property and it loses its status as a brand new property and becomes effectively an existing property or an established property, it'll drop back to market price.
Yeah.
True market price. And whenever someone's buying off the plan, they'll always tell me about what the unit upstairs sold for and what the unit downstairs sold for, so the one they're looking at must be worth X. And it's like, no. What you must do is the property you're looking at buying off the plan, you must judge that value-wise against all the other listings in the broader market. Because if you put a deposit down and you can't reverse the contract on this off-the-plan purchase and you decide to sell it as settlement gets close or shortly after settlement, you're not going to be able to sell it based on what's floor 9 sold for and floor 7 sold for, therefore floor 8 is worth X, Buyers are just going to assess what you're selling with every other listing in the broader market. And that's why this is flawed from a real estate perspective. It might be good politics. Others will have their view on that, about making negative gearing on brand new properties only. But you will see an element of demand drop back on existing properties, and you will see a bubble, a price bubble forming in brand new stock.
Is the government's hope here that by pushing the negative gearing, not only do we get more dwellings, that's the theory, but is the hope that the potential investor is willing to offset the sky-high cost of construction and, one of the limiting factors in housing supply at the moment is the fact that it's so expensive for developers to build, that they're not building some of the stock. There's all the other red tape and issues behind the scenes as well. But one of the issues is it's quite expensive, so the premiums are high. Is the government's hope here that investors just pick up the slack and then say, well, I can offset the cost anyway through negative gearing?
It's one way for government to subsidise building en masse.
Yeah.
Yeah. So what people are going to realise in the next 1 to 2 years, it won't be this Saturday, but what people are going to realise in the next 1 to 2 years, what role negative gearing, the way we had it, played on keeping rents down.
Yeah.
So what was happening is the government, it wasn't through social housing, it was by aiding and abetting the open market, but the government through negative gearing was inadvertently subsidising rents.
Yeah.
And over time, that is going to be washed off as negative gearing. Investors are not negative gearing in the established market, yeah?
Yeah, well, they're not just going to take a loss for the sake of it.
That's right. Now, what's going to happen with the brand new market is the government are going to find themselves through negative gearing subsidising, because a price bubble will form, they will inadvertently find themselves subsidising developers building at a time that's expensive, and they're prepared to do that because of the amount of people coming into the country, what a big issue immigration is in this country at the moment, and housing, and they're clearly prepared to do that.
So my question for you is, given that it's only for new builds, and let's say, Sydney as as a metropolis is somewhat overpopulated centrally. We know that. There's urban sprawl occurring, but it's not occurring at a rate that we need. Given that the negative gearing, i.e. future rental pool, is going to be concentrated outside of those areas where the new builds are occurring. What is this going to do for the market more broadly, other than just line the pockets of developers and push housing up for, those that could use new housing near where they may work or they may live and school, etc. It's not going to do anything for supply in the majority areas that actually require it.
Look, great question. Let's narrow the geography of it, though.
Yeah.
Let's just make it a market that people can sort of wrap their head around, rather than saying all of Sydney, which is a city of, 5 million now?
Yeah, maybe. Yeah. Probably more, I don't know.
Yeah. So I was with a group on budget night, and they said, what is your take on what these changes will do to the property market? And I said, well, look, just look at where we are in the inner west. There's only one mass project taking place at the inner west at the moment, and that is Tigers.
Oh, yeah. Okay. There's proposed ones, but nothing else actually building.
Nothing actually building that an investor who wants the negative gear can go out and say that property there is the one I want to buy.
Yeah.
So investors who do want to invest in the inner west now must find a brand new property, and there's isolated duplex sites dotted around the place. There might be a medium rise apartment block or set of townhouses going up here and there, but essentially there's nothing.
Yeah. Well,
yeah?
That's my point. Yeah.
Yeah, that's right. But there's Tigers.
Yeah.
Now, prices in Tigers, depending on what floor you want to be on and what size you need, are ranging somewhere between 2 and 7 million, I believe, the ones that are left.
What? That's insane.
Okay, so think about this. Those apartments between 2 and 7 million is meant to be the rental market of tomorrow in the inner west under the Albanese government in Albanese's own seat.
Yeah. Yeah.
And I said to people, who thinks that is a plausible plan? I was like, well, of course it's not. It's like, well, show me where the next project in the inner west is that is going to appeal en masse to investors who then create rental stock for tenants.
Yeah.
So this is why people are saying a few things coming out of the budget first and foremost, rents are going to go up.
Yeah.
Because investors were subsidising those investors that were negative geared, and a negative geared is a fancy word for a weekly loss.
Yeah.
That was one of the first lessons I learned when I came into real estate. You want to be positively geared, not negatively geared, but people have had this fascination with negative gearing, and the Sydney market has been kind over a long time, where I'll take a small weekly loss in the form of negative gearing. I'll split that loss with the government, and I'll get a payday, in terms of the sale price at the end, which justifies the totality of the investment.
Yeah.
Yeah. But those investors are now out of the market. And if those investors don't all want to buy in Tigers and create rental stock, there's no rental stock.
Well, and let's be honest, who's buying a $2, $3, $4, $5 million apartment and leasing it for an affordable value anyway? It's just not practical.
That's my point.
Yeah. Even with negative gearing, it's not practical to make that kind of loss.
So the reason this won't show up on Saturday, but you'll start to notice it accelerating in 6, 12, 18, 24 months, and that'll give the government enough time to say, no, it's not our negative gearing, it's something else that they'll come up with, is that landlords will begin to sell out, and we'll come to capital gains tax and pre-1985, but landlords will begin to sell out, and as they sell out, they'll be exclusively appealing to owner-occupiers, so it's not replaced
By investors.
And the rental pool is shrinking, and there's nowhere for incoming investors to come in and ease the burden. So what you're going to see is rents go up strongly in existing stock, and only when rents get to a point where investors are positively geared will they come back into play.
Yeah.
And in my time,
and that's not a short-term play. It's not a 10-year plan either, but it's not going to happen overnight.
It's not going to happen overnight. I don't pretend to know how long it'll take for the market to recalibrate. So my first 3 investment properties were 2 in Adelaide and 1 in Perth.
Yep.
And they were positively geared off the bat. I've never, in my 27 years, seen a positively geared property of any credibility. Obviously, there's compromised properties for whatever reason, but I've never seen a run-of-the-mill quality property in Sydney that's positively geared in my 27 years of selling real estate.
Yeah.
But I believe the market could recalibrate to that point where investors are just not interested unless the rent covers the mortgage.
Which is the logical way, that's the logical way to invest from the outset. But of course, it's just never been that way.
It's the logical way to invest in the absence of negative gearing.
Correct.
And that's why I say the government were inadvertently subsidising rents in the property market, and they've now torn that away, and that will become obvious.
Yeah. Yeah, and I don't see, the government talk big, and I think a lot of the commentators, whether they be, I guess, reasonable or respected people commentating in the space, or whether they're just, social media pundits having a conversation, many people are excited about this because their viewpoint is, again, if that's the case and investors leave the established market, then naturally prices will come down and the owner-occupiers will be able to buy into the market, which again, may happen with a recalibration in time, as you say. But it's not going to mean that, if the budget passes the Houses, in the Senate, it's not going to be 2 weeks later that all of a sudden that 3-bedroom house in Rozelle that was $5 million is all of a sudden 1.5. The market's not going to calibrate to an extreme level, and if it does do so, it's going to take time, and it's certainly not going to impact supply, which is the major issue to begin with.
Yeah, well, just on that point, further that point, Kieran, in 2019, I did a radio interview with Chris Smith about the Bill Shorten plan and the negative gearing, and I went back to my computer and printed my notes out this week to look at what we what I was saying about this issue then, because it's essentially the same issue. And I was on Chris's show earlier this week discussing this again. And what I said in 2019, which holds equally true today, is that part of the recalibration is yields need to jump sharply, property prices need to fall sharply, or a bit of both.
Yeah. Which may happen in this scenario. But again,
in 2019, a bit of both was plausible because the market was in a different space. There's an undersupply element here at the moment with rising interest rates. So it's a little bit harder to know, are yields going to jump, a price is going to fall, or is it a bit of both? I think yields are going to jump more than prices fall on this one. At this point.
Oh, look, I agree, and that's kind of the point I'm making, is that those out there that are expecting there'll be some incredible property correction off the back of all these changes, and that all of a sudden those people that have been renting will be able to say, oh, well, it doesn't matter that rents are going to go up because now we'll be able to buy the house we want. It's just not a reality. And if it does happen, it's not happening in the short term. This is a long-term plan. To me, this kind of rings as Albanese in his government laying the groundwork for this Homebush 2050 project, that kind of, ambitious project of building 200,000 units in Homebush, which sounds amazing for meeting supply, except it's 25 years away from supposed completion, and, seeing no plans, it's amazing to have ideas. I encourage everyone to have ideas, but you've got to follow through and actually have some practical solutions.
We're talking about Tigers because it's well into construction.
Yeah, the signs are up.
It's not close, but it's well into construction, in fairness.
Yeah.
It's not close to completion, but it's well into construction. Like, I've had clients buy there in the last 2 weeks. It's getting close and it's getting real. Once you put a red pen through Tigers, as far as the inner west goes, very difficult to see the next project of a similar size.
No, well, I think the next proposal was, filling in the gaps on Parramatta Road. But again, there's been no real kind of concrete plan. There's been no design.
Glebe Island, all of this. When they're bringing 450,000 people a year in, okay, or more. You've got your plan, as you say. But where does everyone go and where does everyone live in the interim?
Yeah, well, this is exactly my point. They needed to start building Glebe Island 15 years ago, not now. They needed to build the Parramatta Road corridor 25 years ago, not now. I mean, retail's been dead along there for a long time. There's been so much opportunity to do something. It's never been done. But, some could argue from the other side it's better doing something than nothing. But again, as you say, you could stop demand in the short term, would solve a lot of problems, and then, slowly fix all the other ones would make more sense. But, we're in podcasts, not politics. That's for sure.
Yeah.
Let's move forward then. The negative gearing is not the only change, and as we've discussed, some people will likely benefit from it. Some certainly won't. One of the other big changes is to capital gains tax. Now, I think a lot of people are confused or don't fully understand what capital gains tax is. But if you can, take us through just very, very briefly what it is and when it activates, and then what the changes are and why they're so consequential, and why the flow-on effects are going to be quite bad, I think, for the market more broadly.
Yeah, well, look, I spoke to a few clients that are on the market with investment properties at the moment, and they felt that the new regime would suit them better.
Right. As in the new capital gains tax?
The new capital gains tax process would suit them better, and that was advice that they'd had from their accountants. So essentially, capital gains tax was at your rate of tax, say 47 cents in the dollar, and you got a 50% discount, meaning you paid 23.5 cents.
Yep.
The government now are indexing that to inflation based on when you purchased it going forward, and people that make a quick killing, well, everyone will be paying at the marginal tax rate.
Yep.
But people that make a quick killing will feel more of their profit paid out in capital gains tax than those people that can offset more of it through inflation. That's the crux of it. There's one of the more interesting side effects of the capital gains discussion is that if you purchased pre-capital gains tax, the introduction of pre-capital gains tax, you didn't pay any capital gains tax when you sold your asset.
Yeah.
So a couple of years ago, only 2 years ago, we sold, say, a property for $4 million for a client, and they'd bought it in the late 70s. It was an investment the entire time, paid absolutely no tax on it.
Yeah.
So when we talk about Jim Chalmers' intergenerational inequality, that was one area where I would give that a tick. I'd give the budget a tick, Kieran.
Yep.
Where that was just here we are 40 years on and people are still paying no tax from a policy that was introduced 40 years ago. And essentially from July 1, 2027, if you purchase pre-capital gains tax in 85, any gain that you make from July 1, 2027 is also taxable at the marginal rate. So you're not going to pay tax on your first
4 million.
42 years of ownership. So it's still a very, very big win for you, but at least it's something.
Yeah.
And, when you talk about fair and reasonable, why should someone who was fortunate enough to be of a working age and buy an asset in 1984, why should they pay no tax? Whereas if you go out there and, work a couple of 80-hour weeks and get an investment property for yourself that cracks a profit, why do you then pay tax on that, whereas they don't? So I thought that was pretty fair and reasonable when it comes to capital gains tax.
Yeah. Oh, look, I agree, and I'm certainly, again, I'm not at all opposed to the government trying to do something about, providing a better safety net for all of us. I think that's the goal of every budget, ideologically. But, it is one of those things that's always difficult to balance. The capital gains is something that has been talked about alongside negative gearing as really hot topics in the budget. Do you think that the changes will have a significant impact on investors in the market? Given that it's one of those things that is hoping to target those that sell off their non-primary place of residence. I mean, is it going to have an impact, or do you think it'll be more like your clients are suggesting that in fact, it actually may be slightly more beneficial for us or for a lot of investors?
Look, those that have sort of ridden the 2-decade boom, bought somewhere between 95 financial deregulation with the banking system and, the Aussie home loans and Wizard and all of that coming into the market. So from sort of 95 to 2025.
Pre-Olympics, the golden era.
Yeah, and even 2000 to 2010, people were buying for very good prices then compared to what property's worth now. Every investor that I've spoken to who's sitting on those really big paper gains, for example, they're really comfortable with the new capital gains tax regime that's being introduced. They have no issue with it.
Yeah.
Someone who, buys a bungalow in 5 Dock, pushes it over, builds duplexes and flogs them off for a profit, they're going to pay more tax.
Yeah.
So I'm not sure if that's who the government was trying to capture, or whether it is just a blatant tax grab. I must say I have a bigger issue with what they've done with negative gearing, because they've misread the impact, or they're lying about the impact that it's truly going to have on the property market. And as I've said, since May 2022, the Albanese government will end up hurting the people that have voted for them, young adults, because every policy they're touching is making home ownership harder, not easier.
Yeah.
Whereas the capital gains tax, that is trying to make it fairer without crashing the market, and it's giving people 12 months to transition so there's not market shock.
Do you think there is going to be any impact, though? You talk about the developer doing a duplex, or let's say someone doing a very small 4-apartment development somewhere.
Yep.
Is it going to impact supply that, again, is already limited here? And you've got, on one hand, the government trying to subsidise and incentivise investors and developers to come in and make some of these builds and provide housing, and then at the same time saying, well, actually, we're also going to sting you we're going to welcome you with the left arm and punch you with the right. Do you think
that's what we say, the big spending, big taxing government, isn't it?
Well, yeah, but I mean, usually they can somewhat keep them separated in their budget alignment. But in this case, they're making two policies in the same sector that are almost, to some sectors of the market, obviously not all of it, but some little pockets that may benefit from it. They're actually hampering the development they're trying to promote, to my mind.
Look, I think, and again, a lot of this is the card table's been tipped upside down.
Yeah.
And this is why I try not to come to the discussion with a political bent, even though, you might not like the politics of the day, or you might like it. It's hard not to. I'm just trying to stay rational. I think the smaller a developer is, or the larger they are, they'll both benefit from this new world that, this post-budget world that we're coming into.
Yep.
It's probably the mid-sized guys that are going to find it hard. And the reason I say that is that a small developer can and will put the name of the project in their 18-year-old son's name.
Yeah.
And so my 18-year-old son, this is his primary residence, and then sell it off and say, look at that, he made a $2 million gain. Isn't that fascinating? What a lucky boy. And that'll be tax-free.
Yeah.
There's so many family members and so many times you can do that, but I think that will be a real play where they'll stop buying these sites in company names and they'll start buying them in their own names and making them capital free, because that is one of the winners out of the budget, the family home, the primary residence, yeah? And one of the losers,
if you already own one,
and yes, and one of the losers out of the budget is rentvestors. Hugely.
Yeah,
like you're on the wrong side of the trade as a rentvestor now,
especially if you're investing in particularly New South Wales, but it's where yields are already low, and all of a sudden you're going to get stung with increasing rents. It's it was a popular thing in the last 5 years, but it's maybe not so popular.
That's right. So flippers who are doing a project every 12 months or every 2 years, moving from company structure to personal structure and using the benefit of primary residence, might be able to duck and weave their way toward a profit. Big developers, as I said earlier, with the investment market being sent exclusively to them, the bigger the better.
Yeah.
Now, so the big guys, as I say, haven't been critical of this. They've just
Harry's stayed mum, knowing he's got a bright future.
Harry hasn't, but Harry's different to the publicly listed guys, and
of course.
He's got his own agendas, which is fair enough too. So not referring to him in that, but your Mirvacs, your Lendleases, Multiplex, those guys, they're not going to come out too critical here because they're on the right side of the trade. Yeah. So it's that mid-size guy that they're under a tougher tax regime. They're going to get some additional demand from the negative gearing, but is it enough to justify the higher capital gains tax they're going to be called upon to pay?
Well, and as we both know from working with developers over the years, one thing that they're big on is margin. And if there's no margin, they won't come to the table.
That's why nothing's being built at the moment.
Exactly. Materials are too high, labour's too high, costs. It's not worth it to go out there and renovate a site or rebuild a site.
Yeah,
as we know.
And if developers start building now, it's only because they think the retail property investor is going to pay a premium to what they should for the product.
Yeah.
And are these properties? So when I was saying I was talking to a group last night on budget night, there was a former government minister there who was explaining that part of the problem in Sydney at the moment, as far as development goes, is that it costs essentially the same to build a block of units in Mosman as it does in Liverpool or Parramatta.
Yeah.
Now, the block of land doesn't cost the same amount, but the construction is about the same. And as we all know, what you can sell, an 85, 95 square metre two-bedroom apartment with views about Balmoral Beach in Mossman for,
slightly different
to the back streets of Parramatta or Westmead.
Yeah.
And that's the problems in the city at the moment, is the feasibility to do these projects in the parts of the city that desperately need them don't stack up.
Yeah. Yeah, 100%. Look, as we move towards the end of the episode then, Peter, I would love to just get a bit of a wrap-up from you around, out of the three major players in property, and I'm not talking about developers in this, I'm not talking about those that we've really kind of done a bit of a deep dive on, but I'm talking about your buyers, I'm talking about your sellers, and I'm talking about your renters in general. Who do you think is probably going to benefit the most out of the changes in the budget, out of those three primary groups? And I'm talking about just your average mum and dad, selling a property in the inner west or buying a property, or, a young family, whatever. And of the three groups, with, say, sellers, for example, is there anything that those groups can do to try and maximise or increase the positivity of their outcomes off the back of this budget?
Look, I think nearly for all of those categories, it goes back to the points we just made. I think there's going to be a flight to quality.
Yep.
So really, as an investor who wants to buy a a buy and hold townhouse in Drummoyne.
Yep.
But it's established and they can't get negative gearing anymore on that. Are they really going to find themselves buying a 2-bedroom unit in Toongabbie because they get negative gearing benefits from it?
Yeah. Well, unlikely.
Unlikely. That's
Never say
right.
never, but
Yeah.
unlikely.
So in one of the winners, and I said this to myself privately last night, and then it started coming through in social media. One of the winners, if you're asking for winners out of the budget, I'll give you a curveball. It's New Zealand property.
Interesting. I was talking about New Zealand property today. Okay.
Yeah. The New Zealand market is currently depressed. It has far more...
Relatively speaking. It's still expensive.
But it is depressed. It is well off its peak.
Yeah.
There's no two ways about that. The exchange is reasonable at the moment, better than it has been Australian to the Kiwi, and it has far more favourable tax policies than Australia does.
So what I'm interested in this because, as you know, I spent some time in New Zealand. I really like the country. One of the issues with going there is salaries, despite the exchange, don't keep up with Australia, which is a concern for many sectors. Do you think that, though, the market that will benefit there is going to be the investor market? Is that what you were proposing?
Yeah, that's right. Yeah, investors will start working out very quickly that going to some of the better parts of Auckland is a smarter play than buying a 2-bedroom unit in Toongabbie with respect to Toongabbie.
I mean,
but the reason you're in Toongabbie is because you're getting negative gearing and the price is loaded anyway, because the day you sign the contract and settle a contract on your Toongabbie apartment, you might settle on it for $990. You might buy it from the developer for $995. I don't know what a 2-bedroom unit in Toongabbie says. That's probably a bit high, but let's say it's $995. You sign the contract, it instantly drops to the broader market price of $895.
Yeah. But that's all right because you save a few dollars on your income tax.
Yeah.
Yeah.
And that's what the government want people to buy into en masse.
Which is fine. Again, that's fine if there was...
It's fine. It was not my money.
No, but it was fine if there was 500,000 new apartments for people to buy into. But again, this is the issue. There is still nothing to buy. And those that you can buy, as you rightfully mentioned, in most areas, are not affordable for the average investor to then flip and make a rental property. It just doesn't stack up.
That's as far as Sydney goes. That's right, yeah.
Interestingly, just talking about New Zealand, the whole reason I was talking about New Zealand property with someone today is I got an ad sent to me just offering investment properties in Queenstown, which I've had once before, but just unsolicited came through today, which I thought was a little bit unusual at the time, but prompted a discussion. But it's interesting you say that, that country that's very similar to ours, very similar economy, but slightly more progressive in many ways, is potentially a better place to send your money at the moment.
When it comes to property.
Yes. That's what I mean.
So over the years, 2013, I had friends and family say, where should I invest? I did say at that stage, Liverpool.
Yep.
Might have been a bit earlier than 2013. I said Liverpool, actually. It was an ugly duckling, went really well.
Yep.
Hobart, 2014. That was a winner.
Gangbusters. Yeah.
You were working with us in 2021 when I said on Chris Smith's show, Brisbane, buy in Brisbane. Yeah. The median house price, if you can believe it, during COVID, the median house price in Brisbane was
in the 400s, wasn't it? It was
no, 555, 560, something like that. I remember reading the CoreLogic report on air, and it was like that. When Sydney was running at a median house price at the time of 1.3 or 1.4, and the Brisbane median house price was 550, it's like that market has been flat for 13 years, and that is going to boom, and that's what's happened. So I'll say to anyone who's listening to our episode today, where should I invest in property if I've got money to invest? Go and research, but go and find a good buy in New Zealand. That is the best place to put your money when it comes to property at the moment.
The only thing I'll say to that, it's good advice. The only caveat I'll add, as someone who's spent a bit of time there, be very careful because lots of Auckland is still under leasehold land. So there are some cracking deals if you look at them online, but you actually don't buy the land and you pay huge rents. So it's just do your research, as all property investments should be.
Absolutely. Look, during the GFC, Kieran, I bought a property in America,
right,
and I didn't do it online.
Yeah, of course.
I flew into America.
Of course.
Yeah, you got to be on the ground.
Yeah.
There's many people that have made a regretful decision by by buying properties online, that's for sure.
100%. I always, open the episode by saying I love budget night. I love sitting down and seeing what the government have in store for me, which is often disappointing, to be honest. But it's certainly one that is big on property, for better or for worse. It's one that has really decided that the property sector is a source of great pain for many people, and the government want to be seen to do something about it. So I really appreciate you taking the time to step through the changes and walking our listeners through what it really does mean for Sydney property as a whole.
Yeah, thanks, Kieran. And look, I guess some people won't like what we've said today. Then it's not politically aligned or socially aligned with who they are at. We've tried to be pragmatic here today, not emotional or come with a bent or an agenda. And we're on the record now.
Yeah,
we're on the record with some of the things that we've said. So we'll see what the next 3, 4, 6 months bring. Because I think people will be rearranging their chips at the table, trying to find the right place for their money and their future with this new system that's been introduced.
They certainly will. And now that we are on the record, you know that I'm absolutely going to check in and get you to update me on the average housing price in Auckland as we move forward. As always, Peter, great to chat. Thanks for coming in, and we look forward to talking with you next time.
Thanks, Kieran.
And thanks to everyone for listening to Current Market Insights. We look forward to speaking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.